War has been formally declared by the bullion banks. Over the past 2 days, the metals market has been witnessing a chart war unlike any we have witnessed before, a violent one. This is a last resort. Furthermore, it is happening at a crucial juncture. That particular line item costs $92. The market is not achieving equilibrium based on the price action since Thursday, January 15th, 2026. Here you are at a crime scene. To protect a solvency level that the banks can't afford to lose, you observe a sequence of coordinated high-frequency attacks. The battle's chronology can be reconstructed. The silver price spiked first thing in the morning. At 92.23, it reached a new record high. Vertical momentum was maintained. They were very forceful purchasers. We appeared poised to surpass the 100 mark in the span of a single session. Afterwards, the hammer struck down. A tremendous influx of paper buyers flooded the Globex market in only a few short minutes. There was no actual selling going on. Alphabetic shorting was the term used. The price dropped from $92 to $86.20 as a result. In an instant, that's a $6 decline. Quickly, the headlines were published by the major media. A crash was what they dubbed it. Bubble bursting was the term they used. You were informed that the smart money was getting out of the market when the rally ended. Nevertheless, an unforeseen event transpired. The market retaliated. The buyers entered the market at $86. They were so aggressive in purchasing the dip that it shocked the short sellers. The price surged again in a matter of hours. It went over $88. It went over $90. It returned to $91.50 and then some. Markets just would not die. Because of this, the financial institutions restacked. As the price was once again threatening to breach the $92 mark, they executed a double tap. Once again, sales erupted. They reduced it to $87.80 again. The bulls' mentality was an obstacle they sought to overcome. Anxieties was their goal. Behold, however, our current position. The price of silver has rebounded once again as we speak. After a series of fluctuations, it is now trading around $90-$30. Such instability does not occur in nature. The graphic depiction of a war of stalemate. There is the material world on the one hand. Many people are aware that silver is becoming scarce, including industrial buyers, sovereign wealth funds, and the general public. Each dip is being purchased by them. A concrete floor is being constructed by them. By contrast, there is the paper establishment. For example, this week is the expiration date for call options held by commercial banks totaling billions of dollars. I don't understand why they're arguing over $92. Then why is $95 not an option? Rather than $85, why not? A huge wall of derivative bets is probably going to have a strike price of $92. The bank's losses will escalate from manageable to catastrophic if the silver price settles above $92 at options expiry. They make their way to the boardroom from the trading desk. Problems with solving them arise. So now they're heating the house by setting fire to their own furniture. So far, they have not secured any contracts to sell. Fighting to protect a single line on a map is using up all of their ammo. However, the market's resiliency at $90 indicates their failure. An earlier year's smash to $86 would have set off a chain reaction of sales. The price would have dropped to $70 as a result. A full recovery would have required weeks. I spent hours on it today. The most telling indicator of fundamental strength is this V-shaped recovery. This proves that the market is responding to a bid that is more powerful and deeper than the bank's efforts to suppress it. Underwater, if you hit a ball, it will bounce right back up. You can control how quickly it rises by pushing down harder. With all their might, the banks are bringing down the prices. They are, however, unable to withstand the physical market's buoyancy. You are intentionally made dizzy by this ping-pong volatility. Its purpose is to induce nausea. They hope you'll feel overwhelmed by the 10% daily swing in your account balance and decide to sell everything just so you can get some sleep. Keep them from getting their wish. Noise is the volatility. The signal is the bounce. Amazing market strength is the reason we are sitting at $90 following two massive attacks. The $80 level is clearly a thing of the past, as confirmed by this. Verification of the $70 level's memorability is provided. At $90, we are constructing a new foundation. This is happening despite the fact that we are facing the most severe suppression effort since 2011. The most crucial question, however, lies here. What caused the price to reverse? Who made the purchase when the chart resembled a waterfall? The average person wasn't the investor. Fear paralyzed the retail investor. The paper traders don't have the same information as the entity that purchased the dip at $86 and $87. They are aware that the Shanghai price remained unmoved even as the New York price plummeted. The Shanghai lie detector will be the subject of the next section of this in-depth analysis. A price of $99.69 was being traded on the Shanghai Gold Exchange as the comics were depicting red candles. We will examine the newly opened $13 premium between the East and West. The bank's inability to win is due to this spread. The price keeps going back up because of this. While China is winning the global war, the banks are arguing over turf in New York. This is only the first battle of the war for 92. The war is going to start soon. Continuing from where Part 1 left off, this section delves into the ground-level realities of the battle. The Shanghai Gold Exchange sent a message that should terrify every central banker in the Western world, while the algorithms in New York were busy painting the tape red and high-frequency traders were smashing the price to $86 to save their options bets. They just spread it out. They didn't sell or freak out. Our analysis of the Asian session's final statistics shows a tale of two markets. The Shanghai market was trading at $99.69 as the Globex market was collapsing. $100 is what it is. There was a $1,349 difference between the New York intraday low of $86.20 and the Shanghai closing price of $99.69. A premium of more than $13 is in the cards. The logistics and arbitrage communities do not consider a $13 difference to be a spread. For the comics industry, it's a financial suicide note. A mathematically illegitimate price drop has been proven in the United States by the Shanghai lie detector. The bank's battle for $92 is a false exercise because of this spread, which I will explain. Commodities are assets that are traded all over the world. The chemical composition of 1 ounce of silver in New York and Shanghai is identical. It is electrically conductive in the same manner. In the same manner, it reflects light. It is valuable in the same manner. After deducting the costs of transportation and insurance, the price ought to be relatively constant across all marketplaces. A void is created when the price in New York falls $13 below the price in China. As a result, it generates a gravitational pull greater than that of any government program. Give some thought to the mechanics of this commerce. A global trading house, Trafigura, Glenore, or even a state-owned bank in China could be staring at a safe way to print money. The COMEX offers paper contracts to traders for $87. They can accept the physical bar and stand by while it is delivered. They can ship the bar to Shanghai and you can make $100 off of it right away. Their profit per ounce is $13. There is absolutely no market risk involved, and the return on capital is 15% in just a few days. At this very moment, this deal is being struck. Moving pallets of silver from London and New York vaults to be shipped east is happening right now. The arbitrage vacuum has smashed the paper price to $86 and is draining the Western vaults dry. For the benefit of the Chinese industrial complex, Western banks have essentially auctioned off all of the United States' silver inventory. The geopolitical irony is something to consider. The topic of safeguarding vital minerals is being discussed at G7 meetings by the U.S. government. Their worst fear is that the silver needed to power missiles and solar panels will be depleted. Still, American financial institutions are handing out subsidies to our greatest geopolitical enemy so they can ship us that vital mineral. As soon as they attempt to defend their short positions by crashing prices, China can corner the market at a lower cost. This nation's furniture is being set ablaze so that their trading desks can stay warm for just one more night. This explains the rapid return to $90 in the price. The $86 price point is no longer sustainable according to the market. By the end of the month, the COMEX will be completely depleted if the price of silver in Shanghai is $100, and in New York it remains $86. At that point, the exchange will fail. New York's price has to go up to Shanghai's price in order to halt the drain. It has a rubber band effect. The more the New York banks pull it down, the more difficult it will be to bring it back up to reality. It turns out that $90 isn't the real silver value, according to the Shanghai lie detector. The price is $100. The New York chart is just an indication that is late. Entities with ill intentions are manipulating the signal, making it distorted. This $13 premium, however, has another level to it. It sheds light on the characteristics of the Chinese demand. So why is China shelling out $100? In the same way that Americans are waiting for the dip, why aren't they? Considering how inelastic their demand is. The solar panel industry is dominated by China. 80% of the photovoltaic modules in the world are made by them. They control the entire supply chain for batteries used in electric vehicles. A great deal of silver is used up by these sectors. The Shenzhen solar manufacturer can't afford to halt production due to a spike in the price of silver. Market share will be lost if they cease operations. They are prepared to pay more for the metal because they know they will have to buy it. The security cost is the $13 premium. The Chinese industry is willing to pay this price in order to avoid running out. People are stockpiling. The company is shifting its focus from JIT to GT plus inventory management. Because they are aware of the dollar's current trajectory, they are strategically stockpiling. Debt is visible to them. People are voting with their spending because they can see inflation. They are selling their paper assets and buying physical ones. In doing so, a concrete base is formed beneath the market. A buyer who relies on the metal to run their factory cannot be swayed. If the price goes down, they won't sell. Just buy more, they'll do. A speculative bubble is essentially distinct from this. Bubble buyers believe they can make more money by selling to someone even dumber next week. People purchase with the intention of using it when there is a shortage. Do not become lightheaded as a result of the New York volatility, the decline to $87, and the surge to $91. Firmly plant your feet on the Shanghai price. While Shanghai remains near $100, any U.S. price below $95 is considered a gift. Because the short sellers are so desperate and inept, they have opened a discount window. However, this window won't remain open indefinitely. When an arbitrage gap closes, it is often with considerable force. The stage is being set for a reversal event in which the US dollar price will rise overnight in an effort to narrow the spread. To put an end to the physical bleeding, we may witness a day when silver opens at $95 and closes at $100. Actually, the war for 92 is more of a struggle against the facts. Banks are doing everything they can to maintain the false impression that silver's value is lower than it actually is. Reality, however, always prevails in the end. In every case, physics triumphs over paper. It is evident from the $13 premium that the paper market is dysfunctional, that the price discovery mechanism is now located in the East rather than the West is proven by this. There has been a change in leadership in New York. On this voyage to Shanghai, we are merely passengers. The paper war will be examined in the following section of this in-depth analysis. In order to understand the mechanism behind this volatility, we will examine naked short positions. We'll break down the bank's predicament, show you how they can't hedge their bets without driving up prices, and justify their doubling down on attacks despite their losses. What a gambler goes through when he tries to recoup his losses. Despite the market's recent upswing, they remain committed to the short side. Someone is calling and the price in Shanghai is the margin call. Using the charts, we have examined the scene of the crime. The $13 Shanghai lie detector has been thoroughly examined. We need to check what's going on inside the machine now. It is critical that we comprehend the bank's price manipulation strategies and, more significantly, why this strategy is escalating into a suicide mission. Seeing the silver price fall from $92 to $86 in just 10 minutes makes you wonder who is selling. Envision a queue of investors who all of a sudden decide they despise silver and would rather have cash on hand. Picture this. Supplies are being unloaded from trucks as they approach the warehouse. However, that did not transpire today. No tangible goods were sold. Samsung kept their battery inventory in-house. Nothing came out of the U.S. Mint's inventory sale. They are completely devoid of any. Solar energy reserves were not sold by the Chinese. The whole transaction took place online. You guessed it. Paper. The naked short works in this way. A bullion bank can smash prices without metal. All they require is collateral. They sell a contract promising future delivery of silver in the future after they join the futures market. They are short on silver, though. Obtaining the silver is not in their plans. What they're selling is an assurance. They trigger a tremendous increase in supply in the opposite algorithm when they sell 10,000 contracts in 1 minute. It cuts the price because it thinks there will be an excess of metal on the market. This is a feat of magic. In order to trump actual demand, they manufacture an artificial supply out of thin air. For 40 years, this strategy was foolproof. After printing paper contracts, the price would plummet, causing hedge funds to freak out, and the banks would profit from buying them back. It was the epitome of criminality. Now, though, the crime was a failure. Why? The beach ball effect is to blame. Picture this. You're in a pool. In your hands, you have a blown-up beach ball. The silver price is symbolized by that ball. Physical reality, industrial demand, inflation, and the Shanghai price are all symbolized by water. The banks are making an effort to keep the ball from sinking. Even though physical reality wants $100, they want $86. It takes continuous, enormous downward pressure from the banks to keep the ball at $86. They must exert every ounce of their strength. To maintain its submersion, they must sell an increasing number of contracts. The more they dig in, though, the more pressure builds up. The market's buoyancy grows. They drove the beach ball far underwater when they slashed the price to $86.20 this morning. However, the ball sped back up to the surface the second they raised their hand, marking the end of the sale. A return to $91 was wrought. A broken market behaves physically like this. Compared to its paper price, silver's intrinsic value has recently risen significantly. Gravity is working against the banks. Next, we will discuss the double tap. What gave them the idea to break it again? For what reasons did a second round of sales push the price up to $87.80? Why? Because the beach ball rose to the air at an unprecedented rate. The $92 surface was once again in danger of being breached. Plus, the banks will go under if it goes over $92. An act of desperation motivated the second assault. So clearly, the resilience is terrifying them. If you slash prices in a bear market once, they won't go back up. When the market is bullish, prices can be pushed up and used as a trampoline. The banks are using ammunition they can't afford to replace in this paper war. Examine the statistics on open interest. Open interest should typically decrease in the event of a price crash. The long position is being liquidated. All hope is lost. However, open interest actually increased today during the drop. Forensic details like this are crucial. What this means is that someone stood there and purchased a contract for every one the bank sold in an effort to smash the price. A lot of people bought the paper. The market was unfazed by the bank's best efforts. A simple opening of its jaws allowed it to swallow the liquid. It appears that a physical long is being met by the paper short. Whoever is buying these contracts at $86 is probably the same person or group that is emptying the vaults. They have secured delivery by using the futures market. This group is betting against the bank. Furthermore, this makes the bank's lives a living hell. They incur a liability with every $86 contract they sell. Silver at $86 is now their legally mandated delivery price. But how will they acquire it? Shanghai is unable to provide it. I paid $100 at that store. The dealers are unable to supply them with it. There is a $120 street price. It is not accessible in the mines. The supply has been taken over. At a price that ensures a loss, they sold something they cannot afford to buy. Their hole is going to be impossible to escape from once they start digging. The idea is that they will invest in the hopes of intimidating you into selling them your actual silver. That is the sole way out for them. Folding is necessary for them. Because of that, the volatility is absolutely nuts. Since they are hopeless at math, they will have to resort to breaking your psychology. The banks will be mathematically bankrupt if you and the industrial buyers both maintain your positions. The market has run out of inventory, and they are shorting it. I refer to this as the war for 92 because of this. The issue goes beyond a simple monetary value. The suppression machine's continued existence is at stake. The banks will no longer have control of the narrative if $92 falls, as the recent bounce to $90 indicates that it will fall very soon. The $92 call wall goes into effect. Trading in futures is a necessary hedge for option dealers. The brief covering starts. This causes a gamma squeeze to occur. The The volatility we've seen today is just a warm-up for what's to come, a vertical move. The leveraged trader, however, is in danger here. There are no escape routes for the banks. Encircled creatures pose a threat. That won't stop them from trying again. They may attempt to break through the $85 mark during the low liquidity Asian opening hours of the trading day. A new scare could be engineered by them. Everything will be done to save themselves from what is sure to happen. Keep the beach ball in mind, though. Their efforts to bring it down only serve to increase the pressure that will cause it to explode in the end. The ball will rise because of the $13 premium in Shanghai. Distractions abound in the paper war. The purpose of the light show is to distract you from the physical drain, which is actually quite real. As the ticker goes green and red, the vaults are being emptied, the rigs are in motion, ships are in the harbor, numbers are being traded by the banks. There is a global exchange of atoms. Part 3 of this in-depth analysis will focus on the plan. How you should proceed in this combat zone is something we will go over. Our decision will be based on the $92 threshold. By week's end, will it have held, or will it break out into triple digits? Above all else, we will bring to your attention the primary reason for owning silver. You can't use it to compete with an algorithm that is biased. The algorithm is malfunctioning, so it's your fault. War has broken out between the banks over the price. However, something was left out. Silver cannot be printed. The conflict is heating up. I have drawn the lines. There is a shortage of paper for the paper tigers. We have reached the end. If you have accompanied me throughout this assessment of the battlefield, you now grasp the entire magnitude of the war we are engaged in. The bank's attempt to break the $92 level was the double tap smash, which you understand. By now you should be familiar with the Shanghai lie detector, which has proven that silver's true value is more than $100. This unprecedented volatility is being driven by paper war mechanics, naked shorting, and beach ball physics, all of which you are familiar with. There is a mountain of evidence. A forensic examination is required. Nobody can deny it. The day the bullion banks lost everything they had by throwing everything at the market will be Thursday, January 15th, 2026. At this very moment, we are examining the chart. Price of silver is $90.30 per ounce. The significance of that number should be considered. The market was impacted by the sale of millions of ounces of paper, which caused it to fall to $86. However, the market simply ignored the setback and climbed back up. Here is the decision. The new floor is the $80 level, according to the verdict. The banks can't halt the rise, according to the verdict. The jury has decided that $92 is an acceptable upper limit. This is just a minor setback on the path to the triple digits. Consequently, what is our next move? For the individual investor caught in the thick of it all, what is the best course of action? Get the end game defined first. Due to options expiration, the banks are vying for $92. This week is the expiration date. The motivation to maintain a low price will be gone after that date. The boot is removed from the market's neck. As a result, the rebound should be visible next week. There will be a release of the energy that was stored during the suppression phase. In time, the rubber band will break. The target for that rebound is clear since the Shanghai premium is $13. The cost is $13. For the arbitrage gap to be closed, that price must be paid. To put an end to the physical drain, that amount is necessary. Overnight, there could be a $10 gap. On the other hand, you won't be able to get there until the following day. There are no escape routes for the banks. They will make their voices heard. They may attempt one last massacre on Sunday night. During the Asian Open, when liquidity is low, they might attempt to trigger a flash crash. You need to adopt a strategy of complete inactivity. Avoid this market at all costs. Attempting to time the swings is useless. Sell at $92 and then try to buy back at $88. That won't work. Someone can lose their position in that way. When the vertical move occurs, that's how you fall behind. Physical silver is proof of victory. You are no longer inside the casino. As your house goes up in flames, you manage to hold on to the chips. Discussing the actual cost is our next topic. Physical metal is selling for $120 from dealers, as we established in part 2. So that's the going rate. You are essentially trading an asset at a 30% discount on the screen if the paper price is $90 and the street price is $120. Putting an asset up for sale at a discount, why? Nobody would. Purchases would increase. The banks are caught in this liquidity trap. In order for them to cover, they rely on you to sell. However, no one is interested in selling the paper contract due to the significantly higher street price. They would like to have it delivered. Because of this, the banks are compelled to bid higher than they would otherwise. A period known as the churn is about to begin. Day after day, the price grinds higher here. The fact that the vaults are empty means that it grinds higher regardless of news, the dollar, or technical indicators. The numbers were in front of us. Yesterday, 1.3 million ounces departed from JP Morgan. Nothing remains of that metal. It will not be returning for $90. The price might drop to $200 later on, but not today. Thus, the war for 92 has been decided. The command is maintained. They have fortified the castle, the purchasers. Ammunition is no longer available for purchase. However, a broader perspective is at work here, an image that transcends the graph.